You know in video games, those enemies that run up to you, steal your gold, and then run away? Those are financial advisors. And today we're going to break down why you should avoid financial advisors in your journey to build wealth. We're going to talk about what financials are and when you will encounter them. Then we're going to talk about their different fee structures and why their fee structures are actually very deceiving and steal a lot more of your wealth than you realize. Then we're going to talk about alternative options and what you should do instead of getting a financial advisor. And I know this video might offend some people. Maybe someone in your family is a financial advisor. Here's my disclaimer. Financial advisors are not bad people. They are human beings just like you and they're trying to make a living. But that's exactly my point. They are making a living by taking some of your wealth. So without further ado, let's dive in. What's up everyone? This is Brandon from Wealth Potion, where we make financial education fun, easy, and approachable by looking at life like a video game. And there are many video game analogies I can use to talk about financial advisors. But first, what are financial advisors? Financial advisors, quite simply, are people that will help you manage your money. And you're often going to encounter them at your bank or your financial institution, like a credit union. When you go in to open up your bank account, or if you already have a bank account and you go into your bank for whatever reason to send a check, there's a chance that the bank teller will ask, have you sat down with one of our financial advisors? They'll likely say something like, you don't have to stress about your money because it's in the hands of a professional. And by the way, they are certified professionals. They have taken tests and courses, and they have this 3 letters at the end of their name, so you can trust them. And last but not least, they only take a 1% fee. This can be all very tempting, especially for people that don't want to stress or think about finances. I mean, you have a day job, right? You probably don't want to also be a financial investor on the side. And that's where the appeal of financial advisors can be very tempting. One video game example is like that NPC character or companion that you ask to follow you along in the journey, but they actually end up not really being a help. They don't do too much, and if anything, they actually slow you down in your adventure. That's a generous way of putting financial advisors. To understand why, we have to look at their fee structures. So financial advisors will have a variety of fee structures, but by far the most common is what's called a percentage-based fee. So when you make money, let's say you make 10% on your money, they are going to take 1%. And it might not be a 1%, it might be 0.75%, but it's going to be some number that sounds quite small on paper. However, it is not that small. And we've talked about this in the past, but it's worth repeating. If you have 2 identical people that are both investing $1,000 per month into the S&P 500, which returns 10% per year, and they do that for 40 years, but one person uses a financial advisor that takes 1%, and the other person does not use a financial advisor, the first person is going to retire with $4 million and the second person is going to retire with $5.3 million. So even though it's just a 1% fee, that 1% fee will compound over time, and the difference after 40 years will be $1.3 million or 31%. 1% becomes 31%. As mentioned, there are other fee structures that financial advisors will use, such as a flat fee. I have a lot of friends that work in the finance industry at hedge funds and family offices, and unfortunately these flat fee financial advisors are generally reserved for the very wealthy because they can afford a larger flat fee that makes it worth it for the financial advisor. For people that are just getting started out, you're almost definitely going to have a percentage-based fee. And that's where it can be really dangerous, because when you're first starting out in your investing journey, it really is only 1%. But over the course of decades, it grows to 31%. One more video game analogy you can use here is pay-to-win games. Everyone knows those games where in order to really become competitive and the best player in the game, you need to pay real money. You need to like buy the best equipment or weapons, or you need to buy the new expansion pack every time it comes out. And if you don't do that, your character is at a disadvantage. That is kind of like financial advisors in that you are paying them 1% to start, but over time, hundreds of thousands of dollars for their financial advice. Where this analogy actually falls down is that generally in pay-to-win games, if you pay money, your character is definitely stronger. But in real life, just because you pay money to a financial advisor does not mean you are going to outperform the market. In fact, most financial advisors, get this, underperformed the market. In the example I gave earlier with the two people, that assumed that they both got the exact same return every single year, 10%. But many financial advisors get a worse return than just buying the S&P 500. And this is why I'm so passionate about this topic. Here is a very comical example. Everyone remembers early 2020 when the cerveza sickness became a thing and everyone was panicking. And if you were investing in that time or you were following financial news, you would have remembered that the stock market was plummeting. It was dropping record amounts day after day after day. Right towards the bottom, there was an article on CNBC, and I will read it out. 8 out of 10 financial advisors see markets diving lower, survey finds. 80% of financial advisors believe that the markets have further to fall. Let's look at the chart. If you had listened to 80% of financial advisors, you would have missed out on perhaps the greatest financial bull run in history. And again, this is not to dunk on financial advisors too hard. My point here is that they are human beings just like you or I, and they are going to be fearful when the markets go down, and they are going to get greedy when the markets go up. So when you think, oh, I'll just give my money to a financial advisor and then I don't have to stress, you still have to stress because they are a human being that is just as emotional and is just as prone to making errors like you or I. Now, if hearing all of this about financial advisors still has you thinking, yeah, but I'd still rather hand my money off to someone else and let them deal with it, then by all means do that. I am not here to judge you, whatever floats your boat. However, if you're listening to this and you're terrified to hear that a financial advisor doesn't just take 1%, but it compounds and it becomes over 30%, or you're shocked to hear that 80% of financial advisors might have sold your stocks at the literal bottom of the COVID pandemic and missed out on a generational bull run, then yeah, financial advisors might not be for you. If you've accepted that, if you're in that latter camp, you might be thinking, all right, Brandon, what do I do next? How do I manage my money? And that's quite simple. It's self-directed investing or DIY investing. That's what I do. That's what I encourage my friends and family to do. Again, I am not a financial advisor, so from a certified lens, I'm not supposed to be giving financial advice. My point is you should not feel guilty about wanting to take your finances into your own hands and control your financial destiny. And the whole point of Wealth Potion is to empower individuals to do more of that. That does not mean you should listen to exactly what I say and invest exactly like I do it, but you should be learning about the world, about finance, so that you can make decisions that fit your financial situation best. And again, another video game analogy I like to use here is think of self-directed investing as an open world video game like Skyrim or Breath of the Wild. It can be really daunting for some people. A lot of people don't like open world games because there's no clear path, but an open world game can be so rewarding and fulfilling because you can explore it on your own pace. You can do whatever you want. You can do the main quest, you can do the side quests, and that is self-directed investing. You have your finances in your control. Now, with great power comes great responsibility. You can't, go to your financial advisor and complain to them. But if you're watching this, I imagine you believe too that the creator economy, the fact that information is freely available on the internet and that we now have AI that can help us, the paradigm for investing is going to change forever. And these middlemen type jobs like financial advisors, I believe are going to go extinct. Again, not trying to pass judgment. Some people's financial situations may call for having a financial advisor. But if you're like me and you want to play the open world game, then come along with me for the journey. I'm sharing all of my wins, all of my losses right here on this channel. I've been investing my money for over 15 years now, which to some people is not that long, to be clear, but I do have some experience. I've made a lot of mistakes along the way, and I'm sharing them all with you so that you don't have to make the same mistakes. If you are in that former camp and you are more comfortable with a financial advisor, here are the questions that I would recommend you ask your financial advisor before signing any paperwork. 1, are you a fiduciary? This is pretty self-explanatory. They should be a fiduciary, meaning that they're a real financial advisor, not just some random person on the street. 2, how are you paid? Have them explain their fee structure to you and see how they explain the 1% fee. Does it sound like they're trying to sell it to you like it's only 1%? Or do they have some acknowledgement that that 1% is going to grow over time as it will. If they resist here, ask them for a breakdown of the fees that you'll pay. And last but not least, perhaps the most important question you should ask a potential financial advisor is, how have your investments performed compared to the S&P 500? And if it feels like they're avoiding the question, ask for real evidence, ask for real numbers that show their performance. Because again, I've talked about this in the past, the majority of active investors underperform the S&P 500. Now that you're in the open world game, you probably want to start investing. And as I've hinted at many times in this series, you could just go and buy the S&P 500 via an index ETF. But there is one level we have to discuss before we start investing. I know, it seems so simple, just buy the index ETF. But I promise this next level is extremely important, because you do not want to lose a significant chunk of your wealth to taxes. And so in level 3, we're going to talk about tax-free accounts and why they're so important that you maximize whatever tax-free accounts your particular government grants to you. So I'll see you in level 3. As always, let me know your feedback. Let me know if you agree, if you disagree. If you're a financial advisor, I'm sorry I dunked on you in this video, and I would love to hear the steelman argument. Why are financial advisors helpful? Why are they valuable? Disagree with me, debate with me. I can take it. I'd love to hear from you, and I'll see you next time. Thanks for watching.